Welcome to my YouTube channel. Today, we're diving into the fascinating world of candlestick patterns. Whether you're a beginner or an experienced trader, understanding these patterns can provide valuable insights into market sentiment and potential price movements. Join me as we explore the basics, decode common patterns, and uncover how to use them effectively in your trading strategy. Let's light up the path to profitable trading together.
Candlesticks are a type of chart used in financial analysis to represent the price movements of a security, such as a stock, currency pair, or commodity, over a specific period of time. Each candlestick typically represents one period of time, such as a day, week, or hour, depending on the chosen time frame. They consist of a body that represents the difference between the opening and closing prices, and wicks or shadows that show the high and low prices during the period.
DOJI, a DOJI candlestick, is a type of candlestick pattern, commonly used in technical analysis of financial markets, especially in stock trading and forex markets. It is characterized by having a very small body, where the opening and closing prices are very close to each other, often at or near the same level. This results in the candlestick having little to no body, appearing more like a horizontal line or a cross. The significance of a DOJI candlestick lies in its potential indication of market indecision or a potential reversal. It suggests that the market opened and closed at nearly the same level, indicating that neither the bulls nor the bears were able to gain control during the period. Depending on the context in which it appears, a DOJI candlestick can signal a potential reversal or continuation of a trend. There are different types of DOJI candlesticks. Here are some common types of DOJI candlestick patterns. Classic DOJI. This is the standard DOJI candlestick, where the opening and closing prices are very close to each other, resulting in a small or non-existent body. It indicates market indecision. Long-legged DOJI. This type of DOJI has long upper and lower shadows, indicating that the price moved significantly higher and lower during the trading session, but ultimately closed near its opening price. It reflects uncertainty in the market. Gravestone DOJI. A gravestone DOJI has a long upper shadow and little to no lower shadow, with the closing price near the session's low. It suggests potential bearish reversal if it forms after an uptrend. Dragonfly DOJI. In contrast to the gravestone DOJI, a dragonfly DOJI has a long lower shadow and little to no upper shadow, with the closing price near the session's high. It can indicate a potential bullish reversal if it forms after a downtrend. Four-price DOJI. This is a rare type of DOJI where the open, high, low, and close prices are all equal, resulting in a horizontal line. It signifies extreme market indecision. Shaven candles, also known as shaven head or shaven bottom candles, are characterized by their lack of upper or lower shadows. Shaven head candle. This type of candlestick has no upper shadow. It forms when the high price of the session is equal to the opening or closing price, indicating that sellers were able to push the price down from the high, but were unable to maintain control, resulting in a close near the high. Shaven bottom candle. This type of candlestick has no lower shadow. It forms when the low price of the session is equal to the opening or closing price, indicating that buyers were able to push the price up from the low, but were unable to maintain control, resulting in a close near the low. In essence, a shaven candlestick tells us that there was little price movement during the given time frame. It might indicate a lack of conviction in the market or a temporary pause in the prevailing trend. Traders often interpret shaven candlesticks as signals of potential reversal or continuation, depending on the context and surrounding market conditions. Spinning top. A spinning top has a small body with upper and lower shadows, but these shadows are typically not significantly longer than the body. The length of the shadows can vary, but they are usually not much longer than the body itself. The key characteristic of a spinning top is its small body relative to the shadows, indicating indecision in the market. Long and short candles. Based on the information from the search results, the distinction between long and short candles in candlestick analysis is based on the length of the candle and the associated market volatility. Long candles. Long candles are characterized by a large price range and high volatility in the market. They indicate strong momentum in the direction of the candle. whether it's an uptrend or a downtrend. Short candles. Short candles have a small price range and low market volatility. They reflect indecision and a lack of strong momentum and low volatility in the market. Marubozu is a candlestick pattern commonly used in technical analysis of financial markets, particularly in the context of Japanese candlestick charting. It's characterized by a candlestick with little to no shadows or wicks on either end, indicating strong buying or selling pressure throughout the trading period. A Marubozu white candlestick is a bullish candlestick pattern that signifies strong buying pressure throughout the trading period. Here are the key features of a Marubozu white candlestick. 1. No shadows or wicks. A Marubozu white candlestick has no upper shadow, upper wick, or a very small one, indicating that the closing price is near the high of the session. There may be a lower shadow, lower wick, or none at all. 2. Long body. The body of the candlestick is relatively long and extends from the opening price to the closing price. The length of the body represents the strength of the buying pressure. In the case of a Marubozu white candlestick, the closing price is significantly higher than the opening price. 3. Color, Marubozu. White candlesticks are typically white or green, indicating that the closing price is higher than the opening price. This coloration emphasizes the bullish sentiment in the market. Traders often interpret the appearance of a Marubozu white candlestick as a signal of continued bullish momentum, potentially signaling the continuation of an upward trend or the start of a new one. However, as with any candlestick pattern, it's essential to consider other factors and confirmatory signals before making trading decisions. A Marubozu black candlestick is a bearish candlestick pattern that signifies strong selling pressure throughout the trading period. Here are the key features of a Marubozu black candlestick. 1. No shadows. A Marubozu black candlestick has no lower shadow, lower wick, or a very small one, indicating that the closing price is near the low of the session. There may be an upper shadow, upper wick, or none at all. 2. Long body. The body of the candlestick is relatively long and extends from the opening price to the closing price. The length of the body represents the strength of the selling pressure. In the case of a Marubozu black candlestick, the closing price is significantly lower than the opening price. 3. Color. Marubozu black candlesticks are typically black or red, indicating that the closing price is lower than the opening price. This coloration emphasizes the bearish sentiment in the market. Traders often interpret the appearance of a Marubozu black candlestick as a signal of continued bearish momentum, potentially signaling the continuation of a downward trend or the start of a new one. However, as with any candlestick pattern, it's essential to consider other factors and confirmatory signals before making trading decisions. The hammer candlestick pattern, a classic tool in the world of technical analysis for trading. It's a single candlestick pattern that typically forms at the bottom of a downtrend and signals a potential reversal in the price action of a security. The hammer candlestick has a small real body with a long lower shadow. Long lower shadow suggests that sellers pushed the price significantly lower during the trading session. But by the end of the session, buyers were able to push the price back up, closing near or at the high of the day. This pattern indicates that despite the selling pressure, buyers were able to regain control and potentially reverse the downtrend. The inverted hammer is another candlestick pattern commonly used in technical analysis to identify potential reversals in the price of a security. The inverted hammer has a small real body near the top of the trading range, with a long upper shadow and little to no lower shadow. This formation indicates that buyers initially pushed the price higher during the trading session, but by the end of the session, sellers were able to push the price back down, closing near or at the low of the day. This pattern indicates that despite a period of selling pressure, buyers were able to push the price back up near the opening level or higher by the close. This pattern suggests that bulls are starting to gain strength and could potentially reverse the downtrend. The hanging man is a bearish candlestick pattern that typically forms at the end of an uptrend and signals a potential reversal to the downside. It looks like a small candlestick with a short body and a long lower shadow, resembling a hanging man, with its legs dangling below. The key characteristics of a hanging man candlestick are: the candlestick has a small real body, typically colored black or white. The lower shadow, or tail, is at least twice the length of the real body. There is little or no upper shadow. The presence of a hanging man suggests that, although the price rallied during the trading session, sellers were able to push the price back down, indicating potential weakness in the bullish trend. Traders often interpret the hanging man as a warning sign that the uptrend may be losing momentum and that a reversal to the downside could be imminent. However, as with any candlestick pattern, it's essential to consider other technical indicators and factors before making trading decisions. The shooting star candlestick pattern is a type of candlestick formation commonly used in technical analysis to identify potential reversals in a security's price trend. It is characterized by a single candlestick with a small real body, a long upper shadow, and little to no lower shadow. Here's how you can identify a shooting star. 1. Small real body. The candlestick should have a small real body near the bottom of the price range for the period. 2. Long upper shadow. The candlestick should have a long upper shadow, also known as an upper wick, that is at least twice the length of the real body. This upper shadow represents the intraday high achieved during the trading session. 3. Little to no lower shadow. The candlestick should ideally have little to no lower shadow, indicating that the price opened near the low of the session and then rallied significantly before closing near or below the open. The interpretation of a shooting star depends on its context within the price chart. When it appears at the end of an uptrend, it suggests that the bulls were initially in control but lost momentum, and the bears pushed the price back down, potentially signaling a reversal of the uptrend. However, traders usually wait for confirmation from subsequent price action before making trading decisions based on candlestick patterns. As I introduced before, here are some key features of the Dragonfly Doji. The Dragonfly Doji looks like a T shape with a small body or no body and a long lower shadow. There's little to no upper shadow, indicating that the closing price was at or near the session high. The long lower shadow extends downwards from the body of the candlestick. It represents the distance between the lowest price and the opening or closing price. The Dragonfly Doji suggests that despite a lower opening, the bulls were able to push the price back up to close near the high of the session. Like other doji patterns, the Dragonfly Doji signals market indecision between buyers and sellers. It often appears at potential reversal points, signaling a shift in sentiment from bearish to bullish. Here are some key features of a gravestone doji. The gravestone doji resembles an inverted T shape with a small body or no body and a long upper shadow. There's little to no lower shadow, indicating that the closing price was at or near the session low. The long upper shadow extends upwards from the body of the candlestick. It represents the distance between the highest price and the opening or closing price. The gravestone doji suggests that despite a higher opening, the bears were able to push the price back down to close near the low of the session. It indicates potential bearish reversal, especially if it forms after an uptrend. Similar to other doji patterns, the gravestone doji signals market indecision between buyers and sellers. It often appears at potential reversal points, indicating a shift in sentiment from bullish to bearish. Engulfing patterns are a type of candlestick pattern used in technical analysis to predict potential reversals in price trends. They consist of two candles, where the body of the second candle completely engulfs the body of the first candle. There are two types of engulfing patterns: bullish engulfing and bearish engulfing. Bullish engulfing pattern occurs during a downtrend. The first candle is a bearish candle, followed by a larger bullish candle whose body completely engulfs the body of the first candle. It suggests a possible reversal of the downtrend and the beginning of a new uptrend. Bearish engulfing pattern. Occurs during an uptrend. The first candle is a bullish candle, followed by a larger bearish candle, whose body completely engulfs the body of the first candle. It suggests a possible reversal of the uptrend and the beginning of a new downtrend. Harami patterns are another type of candlestick pattern used in technical analysis to identify potential reversals in price trends. The word harami is Japanese for pregnant, which is fitting because this pattern consists of two candles where the smaller candle is inside the range of the previous candle. There are two types of harami patterns. Bullish harami. This pattern occurs during a downtrend. The first candle is a large bearish candle. The second candle is a smaller bullish candle that is completely engulfed by the body of the first candle, essentially appearing inside it. It suggests a possible reversal of the downtrend and the beginning of a new uptrend. Bearish harami. This pattern occurs during an uptrend. The first candle is a large bullish candle. The second candle is a smaller bearish candle that is completely engulfed by the body of the first candle. It suggests a possible reversal of the uptrend and the beginning of a new downtrend.